Mohan began to save for his daughter's higher education 16 years ago. He invested 30,000 rupees a year in a PPF account at 10 equity-linked savings scheme. Mohan unexpected his equity investments to grow at 16 to 17%. The rate is lower than 8% now. His calculations showed that he would have 17 lakh rupees when his daughter was ready for higher education. When someone says that the long-term return from equity of 16%, they are referring to the average. Each year's return will be different, and Mohan end value will depend on how the return was each year. The long-term average hide the fact that in the short-term returns are volatile. Mohan ends up with a lower amount because the market was down when he needed the money. Mohan should not be driven by the illustrator of returns but rework what the end value would be across various market cycles. He should have invested a bit more and assumed a lower return. Mohan's equity investments went through both the bull and bear market cycles in 16 years. As his goal draws near, there is a risk that the final value would be wildly different from the expected value. Mohan can do better if he kept an eye on the proportion. His 60% in equity waterfall down in a bear market. That is the time to invest some more. It would have moved far beyond 60% in a bull market, and that is the time to pull some money out and invest in a debt. As the goal draws closer, in order to protect the end value, he should have booked out the risky equity and kept the money in the stable debt product. Long-term investing requires careful strategy, active monitoring, and timely protection of the end. Don't invest and forget about it, and hold long-term will take care of everything.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.